Hi, welcome to Live at Noon. This is Dee Dee Jones, Innovative Financial. Here we're talking about tax breaks available to retirees. Yep, those of you getting these statements, actually you're getting checks now. There are tax breaks that are available that frequently retirees aren't aware of, or they don't know how to take advantage of them. I'm going to walk through a few of those with you today. So we're going to start right with the first one, and that is if you're age 65 or older, you're entitled to a larger standard deduction. And we know that a couple of years ago, the Tax Cut and Jobs Act bumped everybody's standard deduction significantly. But at age 65, each person that's over 65 in the household gets an additional $1,650 or $1,600 per person. So it might make it harder for you to itemize, but if you weren't going to itemize anyway, that's an extra, say $400 of savings for you because your standard deduction is higher. So there we go. If in retirement you become self-employed, you can make your Medicare premiums deductible as a self-employed person. Now, if you're still working, your medical costs aren't deductible, but as a self-employed person, they are. So if you fall into that situation, yay for you, they're deductible. Spousal IRAs. Say one of you, you're in a couple, one of you is retired, but the other one is still earning money. If you're retired, you're eligible to contribute money to an IRA as a spousal IRA, subject to the same limits as if you were working. Now, this is IRAs, not 401ks. So the limits are lower for IRAs, but if your spouse is even working at a company where they have a 401k, you can still contribute money to a spousal IRA. So you have savings opportunities and a way to reduce your taxable income, which if one's working, one's not, and you have the cash to do it, brings down that effective tax rate. Next, this is more of a planning issue, but it's timing of tax payments. As a W-2 or an employed worker all your life, you've experienced tax withholding. The money comes out throughout the year. There's a couple of strategies once you're retired. One is you may be subject to quarterly tax payments. That's what I feel like a lot of the folks we work with think is going to happen, but that isn't necessarily so. But the goal is to make sure that at the end of the year, you don't owe more than $1,000 to the IRS, because if you breach that $1,000 threshold, they're going to hit you with late payment penalties, etc., underpayment penalties. So we don't want to do that. So we want to make sure we keep the taxes due at the time of tax filing at $1,000 or less. It sounds like that's a big target, but some years I tell you that's hard to hit. One way we can do this that keeps a little bit more money in your pocket is if you're taking out IRA distributions, wait until the very last minute. And when you take out that IRA distribution, make sure they withhold enough to cover your taxes for the year. And what that does for you is that money stayed in that tax deferred account for as long as possible. And the IRS considers money that is withheld to be withheld ratably over the year. In other words, it covers your bases. And they won't say that you underpaid throughout the year. So that's an interesting strategy. Depends on how much money's coming out of IRAs for you. Pensions. If you have a lump sum pension payment coming to you and you don't give specific instructions to the issuer of the check, they will write the check to you, and they are required by law to withhold 20% for federal taxes. Not only that, you can't get that money back until next year if you were to roll that over. So the way to avoid that particular trap is to make sure that the check issuer makes the check payable to your IRA, and then they don't have the mandatory 20% withholding. Huge. So it's a huge amount and hard to get the money back. So we like to try and avoid that particular one. RMDs. Now, I'm talking to you about this in the middle of 2020, and RMDs for this year have been suspended. But in the future, when you have those, timing again, much like I said, around the taxes toward the end of the year can give you some tax planning ability for that. And giving money to your family. So if you have an estate large enough to be subject to estate taxes, and as of this year, that's $11.58 million per person. A married couple is 2 times that. If your estate is larger than that, doing some family gifting is a strategy to help reduce future tax bills. There's going to be some uncertainty around the estate tax threshold as we potentially have changes in tax laws. So keep your ear to the ground on those changes. But under the current regime, you can give $15,000 per person per year without any tax obligation or reporting obligations. So a married couple can give $30,000 to each person that they want to, and actually do quite a bit of gifting if that's important to you. Now, I get it. There's not a lot of folks in that particular strata, if you will, but if you are, this is a good strategy to consider. Now, one of those funny things about new laws, the new tax law moved required minimum distributions out to age 72, but it didn't affect the qualified charitable distribution, QCD. And what a QCD is money that comes from your IRA and goes directly to a charity without you being in the middle. And what that does is keeps that money that's coming out of the IRA from being reported as income on your taxes, which helps with those other thresholds. We'll talk about, medical deduction thresholds and other things. Using QCDs keeps your adjusted gross income lower. So that can be really valuable if you're charitably inclined. And my last tip for tax breaks that are available for seniors is the possibility of getting tax-free profit on your vacation home. So say you're somebody who's, you've lived in the city, but you've had the vacation home for years, you're ready to downsize. So you've sold the house in the city and you've gotten the exclusion on the gains, $250,000 per person, one or married couple is $500,000. But you weren't eligible for that on the vacation property. What you can now do, live in that vacation property for the 2 years out of 5, go ahead and sell this, and you would be eligible for that tax break a second time and avoid the taxes on the gains on that property. So those are 9 ways that seniors can take advantage of some special tax breaks for their planning. Those are in effect for the year 2020. Likely be in effect for next year, but I tell you, things are still moving. So tune in. If there's changes, we'll bring them to you here. This is Dee Dee Jones, Innovative Financial, live at noon, Monday, Wednesday, and Friday. Be sure to like and follow us so you know when we're sharing with you new information so that your financial life can be successful. Thanks for joining me.